Hello and welcome. My name is Michael Hurley and I'm the Deputy Editor at Environmental Finance, and I'll be moderating this webinar discussion today. Thank you very much for joining. I'm the Deputy Editor at Environmental Finance, which is a news analysis service, online news analysis. Delighted to bring you this webinar on the climate risk toolkit scenarios, models, and getting it right, which is run in partnership with Clarity AI. And in my coverage as a journalist of sustainable finance, I've written a fair bit about climate change scenarios, which exist to try to capture some of the uncertainty about future climate change to the extent that's possible, obviously. Often that's been writing about the range of short-term and long-term scenarios published by a group called the Central Banks and Supervisors Network for Greening the Financial System, or NGFS, but also by a variety of others, including a range of commercial providers. And there's been a fair bit of debate about the whether and which of the several scenarios best capture the range of potential warming scenarios and their impacts for financial institutions in particular, such as boiling this down to impacts on investment portfolios across a variety of possible futures. But it's less common to get a comprehensive exploration of how these scenarios are applied in practice, including case studies of where that's done. And that's what I'm particularly looking forward to hearing in today's session. To make sure you in the audience get the most from the discussion, I encourage you to submit questions you may have about how Clarity AI assembles its scenarios, the use cases, or anything else as we go through. We've also got Jessica from Nuveen to offer the investor perspective, so questions from that angle will be very welcome as well as we go through, so please do send those through as we progress. We're going to be proceeding through the session in stages with a round of introductions kicking us off, then a first segment which will explore Clarity AI's use of top-down economy-wide analysis, and then a second segment on bottom-up asset level analysis, including commentary on using corporate disclosures to inform that level of analysis. And after each of these two segments, I'll put your questions to the experts. So without further ado, turning to those experts, obviously I'd like to invite you each in turn to briefly introduce yourself, starting perhaps with Jessica and Nuveen to bring the investor perspective, and then I'll turn to Nico and Jean-Charles, who will then present a few slides summarizing Clarity AI's offering. But Jessica, first of all, would you mind just briefly introducing yourself?
First off, thank you, Michael, for inviting me to this really interesting and innovative panel today. I'm Jessica Zarzicki. I'm a portfolio manager at Nuveen. Nuveen is a $1.3 trillion asset manager. My specific role at Nuveen focuses on our dedicated ESG and impact fixed income strategies. Currently managing just over $24 billion in dedicated ESG and impact strategies, which are all total returns, so focus on financial returns and how can we mitigate risk within the portfolios. And I think the climate solutions and looking at different scenarios is an important part of that. When we think about fixed income, I think one of the most powerful tools within the fixed income market is we can really use some scale solutions, right? And how can we do that in terms of scaling innovation in technology, helping companies and governments mitigate some of the environmental challenges? And that through fixed income can be used through green, social, and sustainable bonds, being able to control the proceeds and drive capital today to some of the challenges that we're going to talk about in terms that the climate faces. So really scaling is a great part of the fixed income solution.
That's very helpful. Thank you. I'm really looking forward to getting your insight as well as your impressions of what we hear presented by Nico and Jean-Charles as we go through as well. So we'll be looking forward to hearing that as we progress. So maybe turning to Nico Fetters at Clarity AI, if you wouldn't mind doing the same.
Yes, thank you, Michael, and thanks to everyone out there who dialed in and shares their time with us today. So my name is Nico. I'm the Climate Product Research Director at Clarity AI. We have one or two slides on Clarity AI, so I'll present that as we go into the presentation. But just about me, I've been with the company for about 2.5 years now, and my role as the Product Research Director is to oversee the development of climate-related metrics and methodologies. And that really spans across the whole segment, including carbon footprint, climate transition, net zero alignment, and then also increasingly now on climate risk. Yes, so that's about me, and then I lead over to Jean-Charles.
Hi everyone. So I'm Jean-Charles, based out of Barcelona. I've been at Clarity AI for 4.5 years now. I work in Nico's team, in the climate research team, and I'm also in charge of the climate methodologies, ensuring they are science-based and using input data, which is of the highest quality possible.
Great, it's helpful. And I believe Nico and Jean-Charles, you wanted to present an overview of the offering, because I guess that kind of contextualizes and frames what we're going to talk through today as on a high level. So was that with you, Jean-Charles, to present that?
Sure. Yeah, let me pull up the slides.
Yeah, so I kick this off. So just two words about Clarity for those of you who don't know the company yet. So we are a sustainability tech company, really focused, going back to the earlier days of AI, really focusing on integrating AI into our platform and processes, and ultimately aimed at delivering high quality ESG data and data solutions to financial market participants and our clients. And then on the next slide, you can see that, for our investor clients, a range of products really spans across many segments, from regulatory compliance solutions to climate and nature risk assessments, ESG integration, and also impact measurement as well. So that is about us. Then let's move to the next slide, JC, because we're then going into the topic of today. So as we all know and all are aware, we're sort of currently on the path of being misaligned with the Paris Agreement. So the risk of increasingly volatile and extreme weather events and risk for physical climate risks is rising. For many financial market participants, the challenge now lies in integrating these physical risks into investment decision making. That's what we're all here for today. This integration is also increasingly demanded by financial regulators, supervisors, and also transparency requirements. We've identified 3 approaches to this exercise, and we would like to touch upon each of them today. So we'll talk about a top-down approach, which is really one that translates global warming into more macroeconomic impacts and then broader financial market impacts. This is an established solution that we currently offer, and it's often used for scenario analysis, stress testing, and also reporting. Then a bit the contrary to that is the bottom-up approach, which is sort of estimating specific climate-related damages to individual physical assets. That can be used for asset or collateral valuation, insurance pricing, and also increasingly for issuer-level risk analysis. And then a third approach, which we're currently working on, it's a bit complementary to the bottom-up approach, is one that looks at corporate disclosures. So really seeing and trying to identify which specific risks and strategies companies disclose related to physical climate impacts. And that sort of analysis then enables users to do a bit more qualitative risk analysis and can also support corporate engagement. So as Michael mentioned, we will do this presentation, but in stages. So we'll pause after part 1 on the top-down approach, then go into Q&A, and then we'll do part 2 on the bottom-up approaches. And with that, JC, I'll hand back over to you to run us through the top-down approach.
Okay, thank you, Nico. So yeah, so that's an overview of the 3 approaches, because these approaches, yeah, they use radically different models. So before diving into the top-down analysis, I just give an overview of these models. the top-down analysis, it starts with scenario assumptions. These scenario assumptions, they can be policies, investments, consumption, emissions, real-world metrics, and they transform that into global warming levels. These global warming levels are then passed to damage functions to understand their impact on the macroeconomy. And these impacts are then transferred to impacts on financial variables, right? So variables like spreads or total returns. Bottom-up models, they work in a totally different way. They start with global warming levels, so scenarios, for example, and they try to understand what is going to happen with the hazards, frequencies and magnitudes in the different regions. These models, they can have different granularities, sometimes depending on the hazard. You could have very high granularity for floods, for example, but a higher granularity for other hazards. And with that, you usually overlay the facilities of the companies you're investing in. So their locations, the type of facilities on the hazard maps to understand the risk exposure. And once you understand the risk exposure, you can start calculating other metrics that are related to hazards that could happen to these properties. And then Nico will detail a bit more the climate risk disclosure analysis, which and how we do that, right? Looking at company information available in reports, websites, etc., to understand what is their view of climate hazards and their impact. So at Clarity, we believe in a multifactorial analysis. We think it's important to have different metrics, different angles to understand an issue which is so complex as climate change is. So we have developed solutions for each one of these approaches. The first one, which we call climate scenario analysis, we have partnered with Ortec Finance for the top-down analysis. And I'll detail that a bit more. The second one, we are partnering with Risk Thinking AI to get physical asset level data and the climate impacts on them. And we're working internally on models to extract information from the reports to understand how companies see and plan, adapt to climate change. So let's deep dive on the top-down analysis. We believe it's the best solution for reporting, stress testing, benchmarking, and strategic asset allocation. The reason for that is because it usually integrates its advantage, its main benefit is high coverage. So high coverage in two different ways of seeing coverage. One is high coverage of undertakings. So you usually require fewer data points to assess the risks of a company with these models. So you usually obtain a way better coverage of your portfolios with top-down approaches. As an example, we cover 99% of the ACWI index. And we have 50,000 public companies in our database. We can always also project values for private companies and all sorts of custom requests. It's also high coverage in terms of risks that are taken into account. It gives a holistic view, not only focusing on the facilities, but also including all systemic risks to the economies of each country, and also including tipping points, for example. So usually you get higher impact values than with other approaches. So it's also a benefit in terms of alignment with warnings from science and the civil society. Uh, so let's look at how Ortec Finance and us we do this overall. So Ortec Finance works with Cambridge Econometrics to define scenarios, and everything starts with real-world measurements, right? So emissions, production, consumption, electricity mix, the carbon intensity of energy, etc., energy consumption. All of this is factored into the scenarios, and then scenario assumptions make projections of these metrics, which all interact together in the macroeconomic model. In that model, these physical flow interact with other parameters such as energy prices and costs, production costs, but also demand, production, consumption, which are classical macroeconomic variables. And these models also include policy side of things with taxes, subsidies, and technology deployment curves, right? It's not enough to have low carbon technology available, but at what speed will the economy be able to deploy it? It's also something important. So as an output of these scenarios, we get emissions, right? Depending on all of these parameters, we get different temperature pathways, and so emissions pathways, which give temperature pathways. And these temperature pathways are fed into two models, one for acute physical risks and another one for chronic physical risks, which provides us information at country and sector level. And that's where we come in and provide more granular data at company level. So, for example, the sectors the company is playing in, its energy mix, its revenue distribution across countries, and of course, asset classes, the size of the position in the portfolio. That allows us to provide a security level estimation, which then we combine at portfolio level to have a percentage impact on total returns that allows our clients to calculate a climate informed returns. So let's have a look. Oh, yeah, just one thing I wanted to mention as well. These macroeconomic models also output transition risks and opportunities. So we are not going to focus today. We will focus on physical risks, but these transition risks and opportunities are closely linked to the physical risks, and they interact together in the same model. So I'm gonna try to be quicker. Top-down model. So let's have a look at the acute risks. Ortec's model estimates acute risks, taking into account so these temperature pathways we've seen earlier, projecting extreme weather events trajectories for each region. So that's what is the frequency, what is the severity of these extreme weather events, and then uses databases of loss and damages of past extreme weather events, combines that to urbanization data, meaning size and growth of cities, to calculate their direct losses. And once they have these direct losses, they use then countries and cities' resilience to extreme weather events. They call these economic amplification ratios, in a way to take into account the vulnerability of the different economies and their ability to rebuild. that provides GDP shocks for each country and year. To these GDP shocks are applied sector sensitivity. Um, this is based on the analysis of how sectors respond and anticipate physical risks. And the financial model produces direct impacts on one side. So the direct impacts to the performance, the financial performance of financial instruments, but also repricing impacts, right? So to what extent markets price in future impacts of physical risks. For chronic risks, starting by the end, we see that these macroeconomic shocks also are input to the financial model with the same sector sensitivity analysis and produce the same type of results. And here for chronic risks, several things are taken into account. First, the high warming scenario, which is the highest warming scenario, integrates tipping points which causes the damage function to be nonlinear, and then applies the temperature pathways to different topics, mainly productivity decline in agricultural, industrial, and labor productivities. And the second one is the impact on agricultural yields, which is then transmitted to food prices and ultimately inflation shocks. Here again, the country's situation is taken into account. So for food prices, for example, that dependence to different types of foods or the share of food spent in their total consumption. So, a conclusion on the top-down modeling. The main benefits is that you get a holistic view of climate change impacts. It includes market risks, direct risks. You get a high coverage of companies and the risks, because you have a holistic risk, you tend to have higher damages in these models. And that reduces the risk of claims of mismanaging climate risks, right? You might have seen lawsuits recently, for example, in Canada, where pensioners have accused their pension funds of mismanaging climate risks because they use models, and in that case, bottom-up models that do not transmit the entirety of risks. So the ideal use cases for these top-down models are regulatory reporting, CSRD, TCFD, etc., stress testing as well, and also strategic asset allocation. But they also have limitations. You get reduced context at company level. You don't have the same level of granularity as with other models, and they are insufficient for real estate and infrastructure investment decisions when you look specifically at some assets in particular. And now I will hand it back to you, Michael, right?
Yes, thanks very much, George. That was really interesting, and particularly I found on the last slide talk about the liability risk aspect is really interesting. I hadn't thought too much about that. I just wondered one question from me in terms of the I guess the question around the likelihood of scenarios materializing, I guess, is a key one for investors approaching this issue. As you're going about providing scenarios, do you assign a likelihood to any of the scenarios happening? And also, in case I missed this, how many scenarios are there presented in the product?
Yes, so at the moment we include only 3 scenarios because we wanted to have something simple. So the scenarios we we include are net zero financial crisis, and high warming. So what are these scenarios? The net zero and the net zero financial crisis, they use the same assumptions in terms of consumption. So they and the same transition. So they have the same outcome in terms of temperature. They are net zero by the mid 2050s, and they end up in a end of century temperature rise of 1.6 degrees, roughly. We had 1.5 degrees until last year, but these scenarios have become unplausible in the modeling that Ortec uses. So there was no plausible way of managing the parameters in the scenarios in order to reach 1.5 degrees. So they moved the net zero point to 2055, and with an implied temperature rise of almost 1.6 degrees. And then the high warming scenario is a 3.7 degree scenario. So you were asking about likelihood. We do not recommend any likelihood. So we are planning to integrate intermediate scenarios, okay, which might be found more realistic. But we don't recommend any likelihood for two reasons. One, when you're managing risks, you don't necessarily want to know the highest probability scenario. You want to also know, you want to manage risk, what could happen, right? So when you go into a car, you put your seatbelt, you know the probability is very low to have an accident, right? But yet you wear your seatbelt. So the objective of risk management is actually discovering the risks. So that's why we have extreme scenarios in order to, for the 1.5 degree or 1.6 degree, the net zero scenarios, discover transition risks. They also include some physical risk, obviously. And then for the high warming scenario, discover the physical risks, right? So that's why we don't recommend any likelihood or probability of this or that scenario to happen.
Okay, thank you. And keen to bring in Jessica as well in terms of how this corresponds, or what any kind of commentary or on observations on what Jean-Charles presented there, and how perhaps that corresponds with your experience at Nuveen as an investor interacting with this type of analysis. What are you primarily looking for, and how does that inform your day-to-day job in terms of assessing the, I guess, the risk associated with investments?
Thanks, Michael, and JP, thanks for the presentation as well. So just kind of on his, he laid out kind of three use cases and areas. We have a great team at Nuveen that focuses on regulatory issues, and so they're definitely looking at some of this information around the regulatory framework. We've got teams that are focused on some of the stress testing. I think where it comes in more on the investment side would be through thinking about some of the asset allocations and strategic asset allocations, right? In fixed income, we're always thinking about how can we mitigate risk within the portfolio. So scenario analysis can start to help us think about vulnerabilities with space across the board, right? I mean, we are in a world where governments are more financially debt burdened, and so there's less governments to respond to these crises. These physical climate risk crises and disasters are becoming more and costing more. So thinking about some of the risks associated with where the physical is occurring, how we can change our portfolio potentially to limit some of these physical risks. Or, there are also opportunities in this space when we think about some of the climate challenges, how issuers are looking to shift their portfolios, their revenue streams to some climate-based solutions that will put them in a leading position in years to come. So we want to look at not just the loss of the opportunities. Within this sector, there's talk about AI and energy demands all over the world. what that potentially means for some of the energy infrastructure that we have in place, some of the secular trends that we're seeing there. And within the AI component, there's also a lot of strain on the natural resources. And so all of these kind of play into different scenarios and outcomes that we're thinking through in terms of how we're positioned within the portfolio. Are we getting paid for those? And then where can we see those opportunities within these scenarios? And I will say we don't want to go so extreme because it's hard to invest 10 years down the road in some of these scenarios. But we are thinking about these changes. We are thinking about how we can position our portfolio, and we're looking at how we can invest in issues that are contemplating these changes and investing in capital today.
And yeah, I guess on that with particularly with fixed income, that's obviously really evident in terms of the time frame over which you invest. I guess is it too soon to say that you're kind of basing specific investment buy or sell decisions on the scenario analysis, or are you looking at scenarios over short term, say 5 years? I know a lot of these analysis products will focus on a very long term period, but is that already affecting investment decisions, or is it hard to distinguish in terms of how this fits into the credit risk analysis?
I think it's good, right? I think it's good to have the scenario analysis of what's occurring today and where you see risk in your portfolios today, and then taking that longer term horizon on how you're thinking about investing, right? We know that climate change is happening. It's happening more frequently. We know that there isn't as much capital to address some of these issues. And so it is an important component that you want to be mindful and keeping an eye on, because it has its potential to, I think in the slides, go from chronic to acute, right? If you're thinking, I mean, in the world we live in today, right, we're talking about energy security, energy independence, high energy costs. All of these energy costs are coming through in terms of potential fertilizers, what that means for agriculture, right? These are real issues that we're dealing with today, and they're going to have implications on how we're thinking about positioning within the portfolio on some of these key parameters of how does it impact growth for a country, how does it impact inflation, and how does it ultimately move into corporate sectors, and what does that potentially look like? So I think chronic can turn into acute, which is why you want to also have an understanding of some of these longer term issues when it comes to physical climate risk.
Okay, thank you. I would like to get in an audience question as well, perhaps more for Jean-Charles to answer in terms of the methodological side of things. There's a few audience questions that have come through. I don't know if any particularly catch your eye, Jean-Charles, but I saw one about the scenario design for acute risk shock. It asks about implementing the capital stock shock, and asks, are you assuming a shock occurring across the entire country, affecting all companies at the same time, or focusing on particular areas, and hence a subset of companies being affected? And the questioner points to an example of flooding. I wonder if you could answer that one, perhaps.
Yes. Okay, so I will try to answer. Are you assuming the shock occurring across the entire country, affecting all companies at the same time? So the damage function it takes as an input the temperature rise. So what is assuming it does not directly. It's not a bottom-up estimate of the impact of a specific extreme weather event, which would then, with their frequency and magnitude, would then be replicated at GDP level. The damage function already takes into account, I mean, calculates the impact directly on the GDP from the temperature rise. taking into account the extreme weather events. So based on the extreme weather events, past extreme weather events and their impact on GDP, this is extrapolated to the future using using the temperature trajectories. So in the case of a flooding, so it doesn't look at a specific case of a flooding, right? It's going to take the increased probability and significance of these floodings and extrapolate that extrapolate the damages it caused in the past to potential damages in the future, taking into account the fact that the urbanization trends and the fact that most of the value of the economies sits in cities, and that the cities are getting bigger and more population is being urbanized, let's say. I don't know if my answer was clear, but basically we don't go from specific. We don't try to understand. We don't go from specific hazards to the impact on GDP. It's a more generic damage function.
Okay. Well, thanks very much for taking that on. I do believe we will return to a bunch of audience questions. We've had quite a lot already, but I do encourage you to continue sending those in, because we're going to proceed to the next segment of the discussion, which will address the bottom-up asset level analysis, which perhaps we'll also touch on, I guess, the physical risks. But I'll introduce Nico to talk us through that segment. And again, we'll take a few questions relating to that segment after Nico's presentation as well. So please do continue sending your questions through. Nico, over to you.
Yes, JC, do you mind sharing the slides again?
Yes, sure.
While JC is doing that, so we're moving from the macro world to the opposite, to the micro perspective, which is really there to isolate and quantify climate risk at the level of specific property, real estate, infrastructure, or manufacturing sites. The primary use cases for this level of granularity are typically found in banking and insurance, where finance and underwriting is directly linked to specific assets and or collateral value matters. Also, there's some regulatory pressure intensifying. The Bank of England supervisory expectations, for example, they require banks to specifically incorporate property level risks in their climate risk assessments. Beyond those worlds of banking and insurance, we are seeing rising demand from our clients, which are typically asset managers for bottom-up risk data, more to inform their corporate risk analysis and potentially also engagement strategies. Anyhow, so just to cover those evolving needs, we have very recently, just basically this month, partnered with Risk Thinking AI, one of the global leading providers in asset level physical risk modeling. And through this collaboration, we'll be providing very precise bottom-up intelligence to our clients going forward. So that covers 3 million assets worldwide across about 15,000 companies, with precise geolocation data for those sites, risk assessments across a range of hazards and also scenarios. And then lastly, also the financial impact metrics that Jean-Charles was speaking about earlier. So where there's a quantification of expected and also worst case losses to asset values. Yes, so today the case study or the example would focus a little bit more on the evolving investment management use case. So portfolio managers in particular can leverage this specific geolocated data to identify companies with a high concentration of assets exposed to material physical risks. So you can categorize companies based on their global asset base into risk buckets. For example, for companies with assets exceeding 60 or 80% of the total, where the damage to the building would exceed 60 or 80%. I mean, you can set the threshold. Those sort of risks, you would categorize them as high risk, and then you can create sort of heat maps and specify and identify certain clusters of risk across your portfolio and see where it's most concentrated across a fund, for example. We think that this type of data becomes, or this type of analysis becomes a bit more decision useful and actionable if you apply certain materiality filters to it. So instead of looking at all company assets, including all offices and sort of less material assets, the data does allow you to filter that for critical infrastructure assets or critical manufacturing hub, logistics centers, and so forth. And then also this analysis can be tailored to specific investment horizons. Sort of that it matches your investment horizon, and also to various climate scenarios. So you can run also scenario analysis with this type of data. The limitation of this, when we're coming from the top-down approach, obviously they were looking here at the costs to replace or repair an asset. So it's a very direct measure of damage. So this type of analysis does not factor in secondary sort of ripple effects, such as global supply chain disruptions or broader macro effects, which are very important and which JC talked about. So on the next slide, we can see how you can zoom in on specific assets that you have identified as high risk. We have a specific example of this chemical company, DSM Firmenich, which operates a facility in South Korea. This has been flagged as, for example, as high risk based on the expected impact, expected damage to the building. When you located on a map, it's actually placed near a river, and the risk thinking model identifies also riverine flooding as the primary near-term threat under, now I have to say that, under a high warming scenario. So this was done using a 3 to 4 degree warming scenario and on a medium-term time frame. So this could look different on other, in other scenarios and time frames. So the purpose of this is really perhaps as a portfolio manager and your stewardship work can also, you have a bit more evidence to go into corporate engagement and dialogue on these risks. So rather than speaking just broadly about physical risks, you can actually, this allows you to flag specific sites that seem vulnerable and exposed, and where you want to learn more about, measures to reduce and mitigate these risks. And then because the models output, damage values, you can also adjust your the company valuations or credit risk models by factoring those future repair costs or CapEx required for adaptation measures. So coming now to the third approach, which we talked about earlier, that is a little bit complementary to what I just shown. So JC, if you can switch to the next slide. This is about the inside perspective. So current work that we're doing, trying to skim through corporate disclosures and really try to supplement that outside view from a sort of geolocated risk model with that inside view from the company. Since the introduction of TCFD disclosures or guidelines back in 2017, it was, and then more recently with other regulatory regimes emerging, ESRS, IFRS, companies, as you know, there's a long way to go still, but companies have disclosed or have increased their climate-related reporting, and that includes on physical risks, right? So, but if you look at it, the data is often still unstructured in many cases, or hard to digest. But here, AI is actually a valuable tool. So we are using large language models to extract and categorize this information better and at a broader scale. And our research also suggests that about 50% of large caps, and we analyze companies with actual that actually have like critical infrastructure and assets that they rely on. So 50% of those companies provide relatively decent amount of details that allows you to map risks to specific hazards, specific assets of the countries in certain countries. So that's good. And the two distinct advantages of this approach is really that it does reveal where the company itself sees where it has material risks and which hazards they feel exposed to. And on top of that, oftentimes you get more context. So companies do disclose often, how this risk could potentially transmit to like financial metrics. So the financial transmission channels are disclosed. So they would say whether it impacts revenues or capex or operating expenditures and so forth. And then crucially, they often also provide details on how to mitigate. They aim to mitigate these risks, manage them, be it through insurance coverage or actually through actually making buildings more sound and stable. So that's kind of essential as well for understanding vulnerability in the end. With the limitation here that the data, as I said, is unstructured, also the way companies do scenario analysis is also not standardized. So the data is not necessarily comparable across companies. All right, and then just to conclude on this, for the next slide, we have a practical example of that, which we found quite interesting in the run-up to this webinar. So we looked again at the company DSM-Firmenich. We looked at what they disclose in terms of material risks under high warming with a medium-term time horizon, and we found that they themselves see extreme heat and drought as key risks that their manufacturing sites are exposed to. For extreme heat, at the top row of this table, you see that there's not a great deal of site-specific information. So we know in which countries in macro regions they see these risks in the future. It's different for drought risks, where they also specify the cities where they see, so the sites and the cities where the risk might occur. They do specify how, like, financial transmission channels, revenues, and OPEX, and then, as I said, so they also say how they plan to manage and adapt to these risks. So extreme heat, they want to ramp up their business continuity planning. And then for the drought risk, they actually specify in detail how they look to employ targeted water technologies and management strategies for water. So perhaps the most compelling takeaway from this is that there's obviously a discrepancy between the two methods. So the geolocation model identified riverine flooding in South Korea as a key risk, whereas the company itself speaks about extreme heat and drought in other countries as the most material risks under high warming and medium-term scenarios. So that's interesting, and that could be, a nice provides for a nice ground for discussion with the company or further analysis into the risks. All right, and with that, that concludes the presentation on bottom-up analysis. Back to you, Michael.
Thank you very much, Nico. Yeah, that was really interesting, particularly helpful to have the case study and practical example to illustrate. You mentioned the complementarity of those two approaches, and it made me think as you were talking through. I write a lot about kind of corporate reporting frameworks. I know you mentioned a bit about previously about regulatory requirements around disclosure on the asset level. But you've also, obviously, given the nature of Clarity AI, talked a fair bit about the use of artificial intelligence to kind of extract and kind of sort a lot of the data. I wondered, in terms of I guess closing the data gaps that exist, and I guess that everybody struggles with, investors included. do you view the application of AI, or do you view the advances in corporate disclosures as most helpful as you kind of advance towards getting broader coverage to kind of populate these models, and I guess particularly on the corporate reporting side, with the likes of the EU Corporate Sustainability Reporting Directive, spread of the IFRS sustainability standards? Do you expect that those will massively improve the level of analysis you can provide, or is that the impact of that only likely to be felt in a few years to 5 years to a decade time?
Yeah, so I hope these regulatory standards and regimes continue to proliferate around the world, and we're not backtracking on those efforts. I think we have been losing a little bit of momentum here. But yes, so those disclosure standards do generally help, especially because most of them by now incentivize companies to conduct scenario analysis. So that is sort of the starting point, right? But when they do that, they typically also disclose the results of that. And that is where, the example that I showed is where we would take that information then from. They would disclose the results of that scenario analysis and also what they do about these risks. And that is obviously beneficial. So any disclosure regime, and that is, kudos to the TCFD in the end. I think the section on physical risk, I always feel like that had been neglected for a number of years as we all focused on, net zero strategies and decarbonization, which hopefully will continue. But I think the TCFD had sort of shifted the mindset and already introduced the topic of physical risk analysis back in 2017, so very early stage. So any new regulation that comes out that builds on that, which is the IFRS, but also I think the Californian CARB regulation does that, and a couple others probably as well. So all of that helps in this regards to advance this type of analysis. I tried to explain, so the data, like we can use AI obviously now better to extract this information at scale. But there's still a little bit of risk of garbage in, garbage out, because as I said, the data is sometimes still unstructured and oftentimes very too generic, right? So it's not like you open a report and you find a neat table with, like I showed earlier, right, with all the risks by hazard and by site, and it's not like that. So you find information scattered around reports. Sometimes there's tables with visuals and stuff. So it's very not standardized. So but AI tools are becoming really good at also reading images, for example, and extracting insights from those. So that all helps, I would say. That could always be better, but I think it's decent enough at the moment for us to start this.
Okay. And Jessica, I was keen to get your insights on particularly on the asset level side of things, because I was keen to understand, I mean, obviously recognizing that your role with Nuveen focuses on the kind of impact fixed income side of things. So perhaps it's helpful to kind of link this question to that in terms of understanding, I guess, how do you think about the physical climate resilience of assets financed by those types of labeled bonds? And do you look for that kind of asset level data? And if you do, how do you apply that in practice with regards to your investment strategies?
Yeah, that's a great question to try to think all of this together. Some of the earlier comments around, high concentration assets where is a bottom-up funnel shop. So we are going to look at high concentration assets. We're going to look where they are physically. So tools like this are extremely helpful when we're thinking about that of an issuer. We're also thinking about what that issuer is doing to mitigate some of those risks within their portfolio, how they're thinking about building out effects in terms of diversification, climate adaptation, how it's actually making that company potentially a stronger company with more stable. And how we think about it at the fixed income lens is going to be through the green, social, and sustainable bond markets, right? How can we drive capital today to support these companies and mitigate some of these risks and create new revenue? I was just as an example, I was just in San Francisco for Climate Week. Lots of talk around technology and AI, But as I was walking around San Francisco for a week and we're talking about some of the vulnerabilities of cities, I actually went to one of our investments, which was the Salesforce Transit Park, right? So we actually invested in the Salesforce Transit Park, which is a really great investment. One, it has a community aspect, a ton of people walking around this particular park, which actually sits above the train station. Part of the goal of this particular investment for the city was actually to mitigate. So it actually collects rainwater, it helps stop flooding. And when you can put a project like that together, right, that starts to reduce some of the economic costs that the city would face and where they see severe rainfall impacts, right? And that is what we want to do when we're thinking about the fixed income markets and capital and steering capital. When we're thinking about AI and energy demands, right, looking at how data centers are thinking about some of these issues, because it's a huge energy sink. Right? For the most efficient data centers, we're looking for data to have where they're actually building the data centers, right? A drought environment is not going to be the best place, and that's going to bring about different climate risks, physical challenges in the future. So we want to be looking at what that issuer is doing in terms of location, natural resources, energy on site, how they're connecting to the grid, they're engaging with communities. And then outside, right, really cool things that are happening in biodiversity and conservation, right? We just invested in the latest bond from the World Bank, focuses in South Africa, kind of building native species within South Africa, sequestration. So there's going to be all kinds of opportunities to come through the fixed income markets that we can drive and scale capital today, hopefully reduce some of these climate scenarios and physical risk challenges that we're facing around the world.
And just very quickly on recognizing that we're fairly short on time, but in terms of how you get that data on the physical asset side of things, be interested to hear how to what extent your experience corresponds with the kind of things Nico was talking about. I think one of the statistics that I picked up I thought was interesting was the 50% of kind of large caps disclose asset level impacts, but I guess below that it gets increasingly murky. Perhaps is kind of off the top of my head. I'm not speaking from experience of the analysis there, but in terms of where you get that data, do you have to kind of dig quite hard to get asset level data? Do you buy it in from third parties like Clarity AI? Do you perform your own analysis using artificial intelligence? And how much of a challenge is that? Or is it on a case by case basis with issuers?
No, I mean, we've got a responsible investment team that sits at the top of Nuveen, who is tasked with looking at data providers like Clarity AI. Right, we're not going to do this alone. We need additional resources, and so kind of looking at different data providers they can disclose. And so we've that segment that's working with the professionals and providing us information on from these specific data providers. Then we're obviously working and engaging with the particular issuers around disclosures. Disclosures that we have, more information that we have, just makes us better fixed income investors or better investors, no matter what asset class you're investing in. Have seen progress. I think I made the point we're not on some of that progress, but we have seen progress. Some standardization, it's balancing some of the costs with the standardization. But the more information that we have, the more disclosures that we have, the better we're going to be able to make these assessments on the vulnerabilities and the opportunities within the things better, more work to be done. It's a multi-pronged approach across different segments of the organization.
Okay. We are coming up to time, but I think some of our speakers might be able to stay on a little bit longer just to answer one or two more audience questions. But if you're able to stay with us in the audience, I'd encourage you to do so. We'll try to tick off as one or two of these questions from the audience, but also perhaps we won't get through to all of them, but I may just try to circulate some of these with our speakers after the session, just in case they do get time to respond to those in writing. But in terms of the there's a question which asks from an anonymous attendee, asks about the with regards to the examples for bottom-up case studies. Are there any examples at the bond level as well? There's one talk asking about the municipal bond climate-related disclosures. Many of them are boilerplate. I guess that kind of talks to what you were discussing, Jessica. I don't know if you would draw out any examples there. And I guess there was another question with regards, perhaps this is one for Nico or Jean-Charles, asking about how you address the discrepancies between the outside view and the inside view. It kind of flags the DSM Firmenich example and talks to them identifying extreme heat as a high risk, but the company being rated as low in the bottom-up approach. I don't know if either of you would like to take that on.
On the example, yeah, well, they're actually both rated with, both analysis came up with the result that the company is at high risk. It's just that it's a different type of risk, right? So, and we're not there yet to reconcile these results. It was just an example. I mean, what we're doing is, this disclosure extraction tool is something we're working on. And then we will see how we compare that with the sort of outside view of risk thinking's data. We just thought it could be an interesting example because it just gives it just tells us that there's not one solution to this issue of identifying physical risks. You need to have, and I think it was in the title of the webinar, but that 360 view of this. Yeah, so that's the answer here.
Okay, thanks. Jessica, do you want to come in on the examples question as well? Or the other examples question?
So on the municipal bonds market,
Yes.
I would say engagement has been relatively successful on asking for additional disclosure from the municipal space. I think oftentimes what we're seeing there is they're trying to balance cost objectives, doing their bond issuance and being able to provide some of these disclosures. But in general, they've been relatively receptive to providing information. For standardization, I think it's probably a long road until we get some additional standardization in that particular marketplace. But there are groups and organizations that are driving that task force forward and trying to get some standardization in that space.
And maybe just time for one very final question before we wrap up. There's one that asked about how maybe tying a couple together in terms of what models you use for the scenario analysis, and then also there's a question on how in terms of the financial impacts on investments, how that's presented to investor clients under various scenarios. Would that be more of one for Jean-Charles or Nico?
Yeah, sure. So I'm not sure I understand the first one. So what models are we using? In the models we've presented, there are different. So the base model is from Cambridge Econometrics. It's called E3ME, and that's a model that's a macroeconomic model where the relationships between physical variables such as consumption, energy, etc., are dealt with, and then the different damage functions that Ortec Finance uses are taken from the literature. So they have benchmarked the different damage functions that you can find on scientific literature. So that's always peer-reviewed damage functions, and they usually take the highest ones, the ones with the highest results. And so then about how do we present the results? We present the results as the main metric is a percentage of impact on total returns. So that allows our clients to take that value we show and apply it to their projected returns in order for them to calculate a climate-informed return. And we provide data on 4 time horizons, so 5, 10, 20, and 40 years. We provide those data points at total risk level. So that's an aggregation of transition and physical risks. And then it's divided into transition risks, physical acute, physical chronic risks. And for the financial, so the net zero financial crisis scenario, which is a disorderly scenario, disorderly net zero scenario, we also have a sentiment shock, which is an abrupt reaction of the markets to a disorderly or sudden transition. Yeah, so that's how the data is presented at the moment, and we show that at portfolio level, at security level, and then that's aggregated at geographical, like region, country level, and also at sector level and sub-industries.
Okay, thank you, Jean-Charles. Worry that we've run a fair bit over time, but that's probably because we've had such excellent presenters and also quite a wide range of questions. As I said, we'll circulate some of those questions that haven't been able to answer in the time today to some of the speakers, just in case they're able and have time to respond in writing to those questions. But thank you so much for taking the time to share those questions with us and also sharing your attention with us for the session today. So yeah, bring us to the conclusion, and yeah, just kind of thanks very much to Nico and to Jean-Charles for talking us through the Clarity AI approach, and also of course to Jessica for joining us to share the investor perspective. It's really valuable to kind of contextualize that, I think. Of course, environmental finance will be following the discussion around climate scenarios in our pages online as well, and we'll keenly follow the development of Clarity AI's products, I'm sure, in future. So all that leaves me to do is thank you in the audience for joining. I hope you found it useful, and I hope you're able to join us for future events as well. And also, yeah, thanks once again to our speakers, and thank you very much to Clarity AI for supporting this event and making it possible. Thank you very much, and goodbye from me.